On today's program, we're going to talk about the 5 big money myths and how you can overcome them. Plus, we'll also talk about that pent-up demand. We keep hearing about this pent-up demand and what are going to be the investment implications as that pent-up demand starts to unleash, particularly as this coming week we look forward to the 3rd version of the COVID vaccine coming online, thanks to the folks at Johnson & Johnson. So much to talk about on the program as we do each and every week. So welcome. Good Sunday morning to you. It looks like it's going to be a pretty hot one out there as I was listening to that weather forecast. The program, of course, Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner and a certified financial fiduciary with Nelson Financial Planning. Why don't you give us a call this week, have our team of certified financial fiduciaries see if they might be able to help you change your life with a successful and cost-effective financial plan. So before we get to those topics, I wanted to pose a question to our listening audience. Do you think it's a good idea to invest $1 and get 58 cents in return? Probably not, right? I mean, that's not a good deal. You would not do that. The only institution or group of individuals that would be crazy enough to do that, of course, the folks in Washington. According to the Congressional Budget Office, for each dollar that the $2.3 trillion CARES Act, now I'm not talking about the one that's percolating around up there that they're trying to push through right now. I'm talking about the one from a year ago, March. The $2.3 trillion CARES Act, for every dollar that it added to the deficit, according to the Congressional Budget Office, CBO, the GDP grew by only 58 cents. Yet, here we are, there's another 1.9 trillion teed up. I mean, the significant aspect of capitalism at its core has to deal with its superpower, the superpower of capitalism, if you will, has to deal with the efficient allocation of scarce resources. Study any economic 101 and you'll hear that concept of the thing that capitalism does best is it sends resources to where they are going to be most utilized. Unfortunately, government doesn't happen. And yet here we are trying to throw another close to $2 trillion on it. And it's not like when you look at the data on households, and folks, I understand. There are certainly individuals and cases and families that you can always point to as the exceptions. But when you try and send a flood of cash into the system, it's going to have some impact. And when you look at the statistics on household savings were approaching 4 trillion as of last month. 4 trillion, 3.9 to be exact, close to 4, if you will. A year ago, because it's been, right, about a year, pandemic-wise, here we are, March starts tomorrow. And I remember it very well. It was the lacrosse game that my son was competing in just before spring break. And we're in the middle of the lacrosse game, and obviously folks in the stands are talking, and that was when Disney announced that it was closing. So here we are. I mean, it's almost a year to the day. And if you look at household savings at that point in time, pre-pandemic, it was 1.4 trillion. Okay, so we're at 3.9 and we were at 1.4. Does that sound, just generally speaking, like households are in trouble? I mean, time and again, we see this. We saw this after the 2009 crisis where again, they did stimulus payments just like they're doing now, just like they did last year. And I'm not saying that that's necessarily bad. I just think that we need to kind of look at the impact of what all of this is doing, because just like we've seen in past history, when you do stimulus payments in the midst of sort of an economic issue, then folks have a tendency to hold on to that, right? I mean, if you're in a tough economic time, you're not going to run out and spend it. You're going to hold on to that. And so what happens when you have sort of that much cash, if you will, besides the problem of adding to the deficit, it does start to change behavior. And there's certainly some positive aspects to that behavior, but one of the biggest things that you can look at right now is the savings rate. The savings rate, again, reflective of the fact that we're at $4 trillion of household savings versus 1.4. I mean, that's almost 3 times the amount of household savings versus where we were 1 year ago. If you look at personal savings rate, 13%. Long-term average, 6.5%. Again, double. Yet, some of that obviously represents some pent-up demand. We're going to have some thoughts on that later in the program. But also some of that represents changed behavior as well. If you look at after the global economic crisis in 2008, households became much more risk averse. Pre-2008, the savings rate had gotten all the way down to like 2%. In 2009, it jumped up to 8%. And again, you go through that crisis and people say, oh, wait a minute, I need to ultimately change my behavior and make sure that I am, in fact, saving money, particularly in a tough crisis. So the good news on kind of the household savings numbers and the personal savings numbers is, yes, people, kind of have more money to work with, and that's great. The rainy day fund looks much, much better for the vast majority of folks. The bad news is that you wind up having some pretty low interest rates, which becomes a problem, again, because that cash is sitting there making next to nothing. And then the other problem that your high savings rates with high liquidity is that can lead to some concerns about inflation. And that's certainly what we saw play out in the market, right? If you were kind of watching what was going on in the market this past week, those inflation fears really hit both stock and bond asset classes pretty hard. And so certainly the stock market reacted, and everybody kind of sees that because you see the Dow and the S&P 500 and you see those in the red. But with bonds, it kind of works not like you would think, because as interest rates shift up, bond prices go down. So if you're looking at a U.S. government securities bond fund today, it's down like 2% since the beginning of the year. And you would say, wait a minute, U.S. government securities, that was supposed to be something that wasn't going to lose money, wasn't going to fluctuate, wasn't going to do any of that stuff. And the reality is, when you see interest rates jump up like we've seen over the past couple of weeks, it can in fact have a pretty dramatic impact on all asset classes across the board. Inflation is a really bad thing. Now, how do you deal with it as an investor? Because like most investors, again, a lot of money sitting in savings. How do you deal with that? Because you're not going to make anything in savings. And what do you do with that? You got a market that's high, volatility in the market. I mean, how do you best do that? Well, one of the suggestions that we would have for anybody that has cash today is to really think about dollar cost averaging that in, much like you would do if you were saving the money and putting it in on a regular basis. The reality is that's still a great way to get money where it needs to get to. So if you set up a plan where 5%, let's say you got $100,000, right? You got $100,000 sitting just cash, trying to figure out what to do with it. The reality is that what you could do is you could do 5% per month, and basically that would mean over the next 20 months, so basically a year and a half, 2 years, you would wind up eventually getting that money invested. And what that does is that eliminates the whole conversation of, well, what's going to happen tomorrow or what's going to happen next month. And if you kind of get into that conversation, what we see people do time and time again is they do nothing, because it's indecision paralysis, if you will, and then the money continues to sit there. We really like the notion of trying to put money in gradually over time and ultimately use that dollar cost averaging type of an approach, because what that does is that really does smooth out the volatility in the market, because you're investing on a regular basis, up, down, sideways, and ultimately that's a great strategy to try and get invested, particularly in these times. And you're going to want to get that money invested, because if there is inflation around the corner, you're going to want the better returns to be able, that come with the equity markets, to be able to offset the impact of that inflation. So some things to consider. We're going to take a break, and we come back. We're going to talk about, our latest blog post. So hang in for that after these messages here on Dollars and Cents on News Radio WFLA Orlando. This segment of the program, we're going to talk about the 6 numbers you need to know. We just did a blog post on our website, nelsonfinancialplanning.com, about it. And so we're going to cover just some highlights on it and leave it to you to search us out on our website and check out that blog post. Along with, we wanted to take a few moments and give an update of some of the pending legislation that is going on up in Tallahassee that particularly affects folks that are state employees. So if you're part of the Florida retirement system or thinking about going to work for the state as a new employee, there's definitely some things for you to be thinking about, particularly given what they're talking about up in Tallahassee. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on the News Radio WFLA Orlando network, along with 96.9 The Game. We also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on your favorite social media or podcast channel of choice. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So make sure you check out the latest blog post that we put up on our website, nelsonfinancialplanning.com. We talked about the 6 numbers that you need to know before you retire. And obviously in life, there's a lot of numbers that you need to know, things like blood pressure or cholesterol level or Guy's PSA numbers, all of that stuff. But these are sort of the 6 numbers that you need to know. So we're not going to go into full detail with them on this program. We actually kind of covered them in prior programs, but just wanted to kind of recap what those are. And if you want to learn more about it, make sure you check out the blog at our website, nelsonfinancialplanning.com. So first one, of course, is sort of what the monthly cash flow is, right? Money coming in, money going out. That's important to know that, because that will help you determine where you need to cut expenses and where you need to improve on savings. So number 1, make sure you know that monthly cash flow number. Number 2, make sure you know kind of the age at which you're going to get your Social Security. Right now, the age of full retirement age under Social Security is transitioning for a lot of people in the middle of sort of shifting from a full retirement age that is 66 all the way up to age 67. So folks like me, my full retirement age is 67. Many folks are though that are closer to that age are seeing that their age is transition. So make sure you know what that full retirement age is for you, because that number determines when you will get your full amount of your Social Security benefits. Number 3 on the list of these sort of 6 numbers you need to know before retirement is knowing how much you have in retirement savings. Obviously, kind of now we're looking at the asset versus liability type of balance sheet perspective on you as an individual. So make sure you know sort of what you've got on the asset side, the retirement savings side, because at the end of the day, that's the piece that you're going to rely upon to generate out income on a monthly basis in retirement. Next up on the list of numbers you need to know, of course, is credit score, right? That determines at what rate you're going to be able to borrow, and ultimately that credit score is a big part of it. If that score these days is below 760, there's definitely some room for improvement. So you want to make sure, number one, when it comes to improving your credit score, make sure you pay your bills on time. That's a big item. And then of course that brings us to the sort of the next number, if you will, that debt to income ratio. You hear lenders in particular, or banks in particular, talking a lot about that. And what that is that's just taking a look at how much money you got to go and pay each and every month to at least pay your mortgage or your credit cards or your car loan or your student loans. That's your debt. That's debt service. You've got to pay that payment every month. Otherwise, you're in default. And then what is that relative to your income? If that's like 70%, you've got a problem. You got too much debt and not enough income to kind of cover that. So you want to make sure that that number, typically below 30% is good. And then of course, when you talk about debts, well, the number that you need to know there is what the interest rate is that you're getting charged on those debts. So make sure you got those 6 numbers that you sort of need to know when it comes to your retirement. For more information on that, check out the blog post that we did on our website, nelsonfinancialplanning.com. So anyway, this time of year, right, it's time for the Florida legislator to meet. I believe this coming week they're going to start to reconvene, or maybe it's next. I think it's this week that they're going to reconvene for its 60-day session, and you're starting to see some of the proposals or some of the things that they're going to be working on during this legislative session. And so if you're a state worker or thinking about working for the state, you may want to be aware of some of the proposals that they're floating around up there. Ultimately, one of the proposals that they've done, and certainly you've seen a lot of changes over the years if you are a state employee, right? If you are in the pension plan, you saw your COLA disappear. If you were in the investment plan, you saw the contribution levels from your employer decrease. All of that is things that have happened over the course of the past decade. Well, now there is a new proposal that effectively gives you no choice in terms of your options, because right now for the state you have the option of doing a pension plan, which is a traditional check a month kind of benefit that ultimately you wind up getting each and every month when you retire. Some different options that you can pick if you want to have that go for someone else as well after you pass, but that's your traditional pension plan. On the other side of the coin is the investment plan, which looks very much like a sort of a traditional 401k, where most of the money that is going in there is employer money, the state, if you will, or your local municipality that is contributing into that plan. And that plan then provides a chunk of money that ultimately you wind up having to manage and generate out income from that during the course of retirement. So those are sort of the two options. Obviously the pension plan, a very traditional option, the investment plan, sort of the newer one, if you will, out there that represents a lot of what's happened on the private side now making its way into the public side, because many private employers, of course, don't offer pensions anymore. So anyway, based on a Senate committee last week, they appear to be making more headway than previously on this one, where they are looking at eliminating the pension plan as an option for future employees. So they're not looking to eliminate it for anybody that's currently working for the state, but if you want to work for the state or have a goal of working for the state, the reality is you may not have that pension. One of the proposals that has in fact passed Senate committee a couple of weeks ago up in Tallahassee requires new employees as of July 1 of 2022. So there's about a year and a half or a year now of sort of gearing up for it. But any new employees as of July 1 of 2022, so the proposed legislation says, would enroll in the investment plan. Currently, new employees sort of still get to pick. The pension now has a longer vesting schedule, investment plan much shorter vesting schedule, but in a year or so, new employees may not have any option whatsoever. So certainly something interesting to kind of see and watch develop. Again, that continuation of the trend away from traditional pension plans and more to those self-funded 401k type plans. So even the state now seriously looking at doing that for future state employees as well. So be aware of that potential big change coming up. We're going to take a break. When we get back, we're going to talk about the 5 biggest money myths and how to overcome them. Next up on Dollars and Cents here on News Radio WFLA Orlando. So what are the 5 biggest money myths that are out there, and how do you try and overcome them? Because it's so easy in today's world to sort of sabotage your finances, right? I mean, constantly rising bills, expenses, and the buy now culture, if you will, are all combining to really propagate some of the biggest money myths out there. So we're going to tell you what those myths are and hopefully give you a strategy to try and overcome them. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, along with the top 25 financial planning podcasts on the World Wide Web. My name is Joel Garris of Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective retirement plan. So probably the biggest money myth out there is this notion of, I don't have any money. I don't have any extra money to be able to save. That's probably one of the most common myths or excuses, if you will, that we hear from folks in terms of them trying to save money. And the reality is that the biggest way to solve that or to fix that myth is to reframe the issue. It's not, instead of thinking of it as, oh, I'll save with my extra money, right? I'm going to do that with my extra money. The reality is you've got to sort of reframe that and get into the habit of paying yourself first rather than last. When you pay yourself first, you're taking a certain amount right off the top when it first comes in, rather than do everything that you want to do, pay all the bills, pay all the expenses, and then whatever's left over, then I'll save that. It doesn't really work very well at all. You've got to reframe that issue and get out of the mindset of saving your extra money. Instead, pay yourself first. Flip it around so that you're taking care of those savings right out of the gate. Because when you save money, you really are planning on paying yourself that money later on when you need it. So flip that around, and that's a good way to try and overcome one of the biggest myths out there in terms of money. Another one that always sort of comes up, and maybe less so now than in the past, but this notion that investing is only for rich people, right? I mean, that's never probably been more untrue, right? You've got lots of options. You've got online apps. I mean, you name it. You've got plenty of options and plenty of access. Word to the warning, though, on here, understand that if you have an app and you're constantly checking and moving and shifting things based upon sort of what you hear as the wind blows, that can start to be more of a trading thing and not an investing thing. Be careful. When it comes to investing, you really do want to be an investor and not a trader. Remember, you don't need a lot of money. You just need consistency. If you took $325 a month and this assumes an 8% return, which is in line with what the historical returns of the market have been over the past 75 years. The reality is that if you took $325 a month, started that at the age of 25, assuming that 8% historical return, you'd have over $1 million by the time you were 65. Stop and think about those numbers. $325 a month. That's not outside the realm of possibility for most folks, particularly if you reframe that issue about paying yourself first. Take that $325 right off the top and invest that. Don't put that in your trading app thing. Invest it into a broad base, even an index fund you could use for that, and ultimately be consistent with that. And the reality is 8% return, $325 a month turns into over $1 million when you're 65. That is certainly an option that's available for the vast majority of people. Another thing that you hear a little bit about is that investing itself is too expensive. And when you look at even the traditional approaches, the ability to set up accounts and open up an account is much lower, and those thresholds are much lower than they ever have been in the past. So remember, when you're using something like a mutual fund or an index fund, those are baskets that ultimately own a broad cross-section of companies. So what that means is that even though you might only have $100 or $300 or whatever the case may be, if you're investing in a mutual fund or an index fund, then the reality is that you wind up getting a fully diversified portfolio at a pretty low cost. I mean, some of the expense ratios, which would be the cost of owning those types of funds, are pretty low, and they continue to reduce down even lower now more than ever. So the notion that investing is too expensive, I think that one is really based upon sort of what's happening in the financial services industry as a whole. That one is really kind of getting less and less of an option. Number 4, in terms of money myths, this notion that, I just pay the minimum and ultimately on my credit cards and on my bills, and ultimately those will go away, and that actually doesn't happen, because the reality is the minimum simply means that you're paying that over a much longer period of time, usually at a much higher rate, so it's going to cost more, and it's going to take longer to pay. So really don't get into that habit of just paying the minimum, particularly on your credit cards. And then lastly, obviously the need it now culture that we all live in today, that's the notion of keeping up with the Joneses. This one may actually be sort of more common than the first myth that we talked about in terms of not having enough money. Similarly, I think keeping up with the Joneses is sort of in that same category, because we all move sort of in similar social circles and tend to match behavior, and ultimately folks wind up really trying to do the same thing as what their friends are doing, and ultimately that becomes difficult if you don't have the funds to do that. So beware of that myth as well, the notion of trying to keep up with the Joneses. Ignore the Joneses and look forward to your future of being retired successfully. We're going to take a break. When we get back, we're going to continue the conversation on just how big the pent-up demand is that we hear about in the media these days as a result of the pandemic. Coming up next here on Dollars and Cents with Joel Garris on News Radio WFLA Orlando. So just how big is the pent-up demand that we all have been hearing about as we kind of look at those numbers? We were talking about some of these numbers earlier in the program about how high the personal savings rate is today and how high the amount of household savings in the aggregate are, over nearly $4 trillion, which is about triple what it was pre-pandemic. And more importantly, what's the impact as that pent-up demand starts to sort of unleash itself on your portfolio? So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, along with one of the top 25 financial planning podcasts on the World Wide Web. My name is Joel Garris. I'm with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So I was reading an article, and I'm sure you've probably seen these articles out there. It's just fascinating when you look at some of the comparisons to 1918 that we can draw out, right? 1918, Spanish flu was a widespread pandemic in this country that really led to a lot of the same types of behaviors, if you will, that we're seeing today, right? The article that I was reading had to deal with attendance at baseball games. Now, obviously, back in those days, the notion of going to a baseball game, that was the thing to do back in the 1918, that time period. And so, if you just sort of look at the attendance at baseball games in 1918, it wound up being half of obviously what it was the previous year, because there was a pandemic rolling through the U.S. at that point in time. And then the next year, 1919, once the pandemic had sort of passed through, attendance jumped back up to about 6.5 million people. And so that pent-up demand that was as a result of 1918 Spanish flu and not allowing people to engage in activities as broadly as they were previously, and then also couple the fact that was the end of World War I, that gave rise to a decade that is known as the Roaring '20s. And so the notion of pent-up demand being an accelerant for growth for a long period of time is certainly, there's a lot of historical precedent for that. So, when you start to think about the different companies or sectors of the economy that have been hurt, as some of which will be the most benefited upon the unleash of this pent-up demand, right? I mean, we all know that tech has really benefited from as what has happened in the pandemic, because there was a much greater reliance upon technology and things like that as we were all kind of working from home. But similarly, there's a lot of different sectors, travel, leisure, that were really hurt disproportionately during the pandemic, that are going to be more of the direct beneficiaries of the release of this pent-up demand, right? I mean, the release of the pent-up demand isn't going to necessarily drive up more consumption of technology, because that's really already happened as a result of the pandemic, right? I mean, you got new TV, new computer for the house, better Wi-Fi, better internet, things like that. That's all part of what we've seen over the course of the past year. And so in contrast to, sort of what we've got sort of happened in the global financial crisis, I mean, there are a variety of things that are a little bit stronger, right? The banking system is stronger. Monetary policy, fiscal policy is much looser, maybe too loose, as we were talking about at the beginning of the program. And then, of course, those high personal savings rates. And you're starting to see, where this pent-up demand, particularly for hotels or travel or something like that, based upon a recent survey, for example, they asked folks, where you plan on booking a cruise in the future, and 74% said yes. I mean, that's a huge amount of folks that are ready to go as soon as they can. Meanwhile, air travel is down globally about 66%, but in places in the world where COVID is not at kind of the peak level, like China, for example, they're actually have seen a return to the domestic air travel that's very comparable to what it was pre-pandemic, only down about 2%. Here in the US, we're still down about 60% relative to where domestic air travel was. So that's sort of the backdrop. And what's interesting, and I actually saw this sort of play out on a personal basis. So last fall, we had plans, some friends and I, for celebration of a bunch of us turning 50. We're going to travel over to Germany and enjoy Oktoberfest. And obviously that got canceled. And what was interesting is what happened with the hotel. So the hotel, though, only wound up giving refunds at about 50%, and they had to be giving us a credit that had to be used at the hotel. So fast forward to this year, and we're looking to the fall and Oktoberfest again, and hopefully, from everything that we're hearing and being told in the media, by the fall things will be somewhat back to normal. And so we're planning this trip back to Germany and back to Oktoberfest, and so we're like, okay, well, we got this credit at this hotel, so we'll just book here. Except the hotel has raised prices by 50%. So the entire credit that I got winds up being used up by the fact that it is a higher price for the room. So I think you're going to see a lot of that. A lot of the pricing of cruises, and if you sort of look at some of these numbers, has escalated as these folks, cruise lines, travel, hotels, I mean, they know that this pent-up demand is a lot of it's going to come into travel, into leisure, those sectors of the economy. And so they have adjusted their prices accordingly, or at least that seems to be the direction where this is headed. We'll see how that plays out, but I guess that kind of makes sense, right? I mean, if there's a huge amount of demand, fundamental supply and demand, right? I mean, if there's a huge amount of demand and you know it, what are you going to do with your price? You're going to raise it. It's that simple. That's just fundamentals. So you're already starting to see that. I've seen that on a personal basis in terms of that stinking hotel over in Germany. So the reality is, though, that backdrop, or that release of that pent-up demand is going to have some different impacts on your investments and your portfolio, because a lot of the companies, like we were saying, that are more tech-oriented really benefited during the pandemic. And so when you look at sort of investor mix and investor allocation, and there was a study done on 4,000 different individual investor portfolios, and what was seen there is that there was a 20% increase to the allocation of growth companies, like the tech companies, Amazon, Facebook, Microsoft, those kinds of companies. And meanwhile, a 24% decrease in what would be those traditional value companies, like a Disney or an Exxon or a Berkshire Hathaway. And so the point of this is that pent-up demand, when it unleashes, it may very well have a greater unleash on the value side of things. Those traditional companies, those companies like a Disney or the airlines or the cruise lines or things like that, where it's going to have a disproportionate impact rather than continuing to flow more on the tech side. More is flowed on the tech side because that's been the reality of kind of how we've been, or how we kind of need to navigate it. So bottom line is, when you kind of look at these numbers, you got a 20% increase roughly in the amount of allocation to growth on the average investor portfolio, and you have a 24% decrease in the allocation to value. That really does suggest that many folks really need to make sure that they check the balance of their portfolio and go beyond kind of that stock bond mix, but really look at what the mix is of growth versus value, because we see when this pent-up demand gets unleashed that it's really going to make a difference to make sure that you haven't gotten out of balance with the value side of things, because the growth side has been very, very popular. But if you consider the pent-up demand, a lot of that's going to be more on the value type of company going forward. So bottom line, make sure that as an investor, you've got a good balance between growth and value, and you're not gotten out of whack, particularly over the course of the past few years. So anyway, we're going to wrap it up and get on out. Thanks for listening to the program here on Dollars and Cents with Joel Garrett.